Welcome everybody. This is Jared Hrabovsky here with CMG Financial. We're going to discuss today why now is the time to buy. So let's jump right in. Today we're going to discuss a few subjects: inverted yield curve, inventory, demographics, forced demand, the fundamentals of home ownership have not changed, and why this winter is a buyer's window of opportunity. So let's jump right in here. First, we're looking at this chart of a 30-year fixed mortgage rate. So what we're showing here is the constant decline over the last 40 years in interest rates. And what we've seen recently was the first breakout of that downtrend in 40 years. And they rose rates sharply. And that is one of the main reasons why we're seeing this slowdown and why most people think we are headed for a recession. But what does that normally mean? Once the government calls it a recession, you can see in these shaded areas, rates drop during those times, right? So if we're expecting a recession, we're expecting rates to drop next year, by the end of next year. And we'll get into why that's important soon. So what we're going to show here is mortgage originations in the billions. And why this is important is follow this gray line. This is a combination of refinances and purchase business. Okay? And what this shows us is that over 2023, 24, and 25, we're still going to be doing better than we were in 2019. Okay? Especially when you focus on the blue bars, which is strictly purchase business. Okay? So business is going to continue to stay strong and get better over the next few years. Now here's an article from Markets Insider saying that mortgage rates are going to fall to 5.4%. And this will most likely happen next year. We're going to get into why you don't want to wait until then to buy. It's best to buy now and then refinance then. And it's just a short time that you will have a high interest rate. And then there's a bunch of options with buy downs and things like that as well, to where you can still have a comfortable monthly payment over the next year. But if you wait, the competition will come back. So here's the federal funds rate, target rate from 1955 to present. And what this is showing us is that every time we hit this recession, what happens? They drop rates. Again, the federal funds rate is going to drop. So they will drop it sometime, probably around this time next year, they'll start dropping it. But rates will drop as the market anticipates that the Federal Reserve is going to drop their rates. So rates, actual mortgage rates will drop ahead of the federal funds rate once the anticipation comes. So what this is a spread of the 10-year Treasury versus the 30-year fixed rate mortgage. And what we're seeing is a sharp divergence here. Okay? And then this chart on the right is showing something similar. This is showing an inverted yield curve. And what that means, an inverted yield curve, is when the 2-year Treasury yield is above the 10-year Treasury yield. And this generally signals a recession and eventually a drop in the Fed funds rate. So there's another indicator we have that Fed funds will drop most likely sometime next year. They're not done hiking yet. They probably have 2 more. They will probably hike in December and again in February, possibly March. We'll see. Now we have a chart of the median sales price of households in the United States. And this is going back from like 1960. So what you can see is a constant uptrend. What does this show me? This shows me that real estate is by far the safest investment in the world. And we'll get into a little bit more of why it's the safest investment with the highest return as well. Real estate generally beats the stock market, and I'm going to show you why. Median sales price. Okay, we had this big drawdown here. And now we know from recent data I just saw from Redfin that the average median home sales price is down to $392. So we are having our pullback in our correction in home prices right now while mortgage rates are high. That is why now is the time to buy, because fear is high, sentiment is bad, which means you can get a good deal out there. Now, this is why it won't last for long. There's a structural undersupply in housing, okay? And this is showing us this undersupply in housing for over the last decades, right? And look at this bar when we go from 2000 to 2009 to this 2010 to 2019. What happened in there? We had a mortgage and housing collapse, right? And a bunch of builders went out of business. A bunch of builders lost a bunch of money because they were overinvested and overbuilding at the time. There was an oversupply of inventory. Okay, so they stopped building. So over the next decade, we created an undersupply of inventory. I can tell you right now that we have word that many of the largest builders in the United States have been ordered to stop building or pre-building any homes across the entire United States. So they are already going to stop building, which means this inventory problem is not only going to not get any better, it'll most likely get worse in the next few years. As builders don't want to take the risk to build houses that they can't sell quickly. So they're going to build to order. And then this article shows the same thing. New research reveals America is short more than 5 million houses. Now we're talking about demographics. Okay, what we see highlighted, these yellow bars, right? We got the median age for moving out is 26 years old, and the median age for buying a house is 34 years old. Well, guess what? Look at this giant wave of population. This is the largest segment of population, the millennials. Right? It says right over here, there's 73 million millennials, and if this big wave here is about to hit the median age for home buyers, we're about to have the largest home buyer wave in history. So pay attention and focus on your millennials. They're about to buy a bunch of houses over the next several years. And this is what's going to keep the real estate market going strong for years to come. Now, we're going to talk a little bit about why buying a house is leverage investing. Most people don't even have the opportunity to do leverage investing. Your broker may not even allow it if you were doing it with stocks. So what we're going to show is how you can your leverage investing when you buy real estate. So we're taking a $400,000 house with a 10% down example. Okay, and we all know you can do less than 10%. So 4%, 10% down on a 400K house, you're looking at $40,000 out of pocket for that down payment. Even if we grow at a 2% rate this next year, that's $8,000. Okay, that's a 20% return on your money. And you're not going to get a 20% return in the stock market this year. I can promise you that. So you got a $360,000 loan at a 7% interest rate. Your principal and interest is $2,395. In year one, you're going to pay $25,000 in interest. Well, guess what? In America, mortgage interest is tax deductible. So you're going to be able to write off $7,525, assuming a 30% tax bracket. What does that do? That brings your payment down to $1,768, your principal and interest, and that's essentially like having a 4.25% interest rate, right? So that's a better way to stomach it when you look at that, and at the same time, you're going to get a 20% return on your money, even at a modest 2% gain. Okay, in year 5, you have $21,126, so you still have good tax write-offs there. Also, you have schools and stability. You can paint it, add to it, do what you want with it. The house is yours. But that's why buying a home is great leverage investing. Now let's talk about net worth by housing status. So this is owners versus renters. You can't even see the renter line down there because that is how low the average net worth is for renters. And then you can see for homeowners, average net worth, we're hovering around $200,000 plus as homeowner. A renter, what is this? Less $10,000 or less? You don't want to be in that category, especially as you get older and begin aging. Invest in your future, buy real estate. It's the safest investment you can make. Focus on these bars here. This chart was a little bit more about demographics. We can talk about that in one sec. But look at this. Your yellow bar here is your homeowner's net wealth, and this little orange bar is renters. Okay, you don't want to. That's a huge reason why you want to be a homeowner. Okay, and then what this also tells me is Black and Hispanic are also going to be predominant home buyers over the coming years, and they will catch up to these categories. I've noticed over the last 2 years, about 60% plus of my pipeline is Black and Hispanic community. So expect them to catch up, but mainly focus on this net wealth. Very, very important to be a homeowner. Now, this is an MBA mortgage finance forecast. This might not mean a lot to a lot of people, but you can download this chart, take a picture of it, study it. I will also put this material up for download later. But main thing I like to see here is that the Mortgage Bankers Association is not expecting any sort of housing crash, no significant slowdown, right? Median home price, right? We're expecting a small drop for 2023. We're already experiencing that now. And then look at that, 2024, right back up. Median home price expected to be higher than 2022 even, and 2021. Interest rates also expected to spike 2022. We're seeing that now, and then fall off after that. 5.4 at the end of 2023, 4.5 the next year, 4.5 the year following. And I think that's pretty accurate. I don't know if it'll be a very long time if ever we get back to the 2s or 3s. I believe they understand that they made a mistake. Home buyers might as well take the plunge. Affordability isn't going to get any better as shrinking inventories ensure prices will rise even if mortgage rates eventually fall. And that's what we were talking about, supply and demand. The supply shock is real, and it's going to be here for quite a long time. So you might as well take the plunge and get a discount while homes are at a discount right now and negotiations are at an all-time high from what I have seen. Here's some more articles. Why the housing market is not in a recession. Millennial demand helps stoke the housing boom. Waiting on the housing market to crash? Don't, experts say. Here's how today's market is different from the Great Recession housing bubble, which we just covered. Millennials will drive home prices for years to come. That's what I've been saying during this presentation. Demographic support for home purchases. As we covered earlier, here's your big wave of home buyers. And now look at this down here. Home ownership rate by age. Okay, so under 35, less than 40% of them own houses. What's going to happen? Look at all these numbers trending up here. This gap will close. And you want to be a part of that. So make sure you are taking care of your millennials and marketing to them and educating them on why home ownership is so important for their future. So you are the difference. The market's going to slow, but it'll still remain above the previous decade. Rates are going to drop next year. Demographics and supply not changed. This winter may be a unique opportunity for home buyers. And this market will right size, meaning there will be less mortgage lenders and less real estate agents over these coming months. So the pool of buyers and sellers will be divided amongst less people. So stay strong, keep marketing out there, and go get them. Go educate your buyers and sellers. And then here's my contact page. If you need anything, I will be posting this video to multiple resources. I'll have a YouTube page at Bosky Media, and then I'm building out this new website at boskymedia.com, where I will cover many different subjects on real estate, finance, and investing. And I'll be producing a lot of video content over the next several days and weeks and months to come. So other than that, I hope you have a wonderful day, and y'all take